Thank you all for joining. I appreciate it. Today, we're talking about how to manage your RSUs. Not an entirely straightforward, simple topic, as you will see. All of the webinars that I do these monthly, and all of them revolve around financial planning. What is financial planning? Well, here's a simple way to look at it. There's two ways that your financial life is going to go. One of these two ways. Door number one, you're going to be able to afford everything you want to do in life. And door number two, you won't. Now, financial planning will not guarantee that you get to do everything you want in life, of course. What it will do is put you in a position to make decisions today based on how they affect you later in life, because we're going to look at your cash flows throughout life. You're going to have a financial life one way or the other, and we want to greatly increase the chance of door number one, any chance we get. With that in mind, talking about RSUs, I want to show you how they fit in the financial planning process. So here are the four areas of financial planning that I think are important. Protect what you have, that's insurance and estate planning. Know where it goes, that's spending. Spending is as important as investments or anything else. Make it grow is investments, and retaining independence and dignity throughout your life. That means we're not going to live off our kids in our older age. We're going to make those decisions today based on how they affect us later in life. We approach all of this with intention and purposeful effort to build your best financial life. Not the best financial life on your block, but your best financial life. Optimize where you can for your situation and for what you want to do. Investments often is what people think of when they think of finances, but investments are just a part of what's going on. And I want to show you my process only to highlight where investments lie. We're talking about investments today, just part of investments with the RSUs, but you see they're way down here in the process. They're not front and center. Investments are the engine that drives the plan. We all want a good engine, but the plan is really what's most important. Oh, I see I didn't hit enter. So I just threw a link into the chat. Let me back up a second. At the end of this session, I'm going to offer you a session to talk about RSUs or anything else, coaching session that you want, a $300 value. There's the link in the chat. Feel free to use it now or later. And I'll put it up in the chat later, maybe for those who are still arriving. Okay, today's agenda. What is an RSU? Why should we have a process to sell our RSUs, or really our company stock in general? And I'm also going to talk about a tax smart way to transition your RSUs into the rest of your financial life, assuming you've built up a lot over the years, which a lot of people tend to do. So first off, what is an RSU? RSU just stands for restricted stock unit. It represents a share of stock. It's not an actual share of stock. It represents one. That's fairly technical, not really that important. It's awarded at a certain date, usually annually, and when you start a new job. And then it vests over time at other dates. Now, on the award date, that really doesn't matter, because when you're quote unquote awarded it, you don't really own it yet, even though you've been awarded it. You only own it once it vests. And that's when the IRS wakes up and taxes you, is on the day of vesting. We're going to talk about that a little bit more. Now, once it vests, here in a moment, once it vests, you can sell it or you can continue to hold it. Totally up to you. One thing to know, though, is if you're leaving work, usually unvested shares will be lost when you leave employment. Sometimes there's a grace period of 30 days or 90 days. But if you're thinking about leaving work, you want to look at your vesting schedule as part of the input. Okay, when should you sell? Well, that's easy. When the stock is high, right? That's when we want to sell, but nobody really knows when that is. You're never going to know what the stock is going to do tomorrow, the next day, or the next week, or the month after that, or the month after that. If you want proof of that, just think about what you thought the stock was going to do in the future 2 months ago, 3 years ago, whenever it was ago. Maybe you are right in a broad sense, but there's just no way to know where the stock's going to go. We want to sell it when it's high, of course we do, but that is not possible to do because we can't tell the future. So what do we end up doing? Here's the typical strategy. If the stock is falling, we don't sell because we want to wait until it goes back up. If the stock is rising, We don't sell, because why would you sell something that's going up? So here's the strategy most people actually follow, whether intentional or not. They never sell. They're not going to sell when it's going down, and they're not going to sell when it's going up. That's no strategy to have. That is not a good strategy for anybody to have, unless, of course, the stock goes to the moon and stays there, and no company ever does. So when should you actually sell? Well, here's some questions to consider. Number one, when will you actually use these funds? When do you need to spend them? If you're going to spend this money in the next 5 years, you should really consider selling now, because if you need the money to, let's say, buy your first home or buy your second home or whatever it is, you don't want that potential expense to be dependent on what the company stock price does in the short run, under 5 years. We have no idea what stocks are going to do under 5 years. We have no idea what an individual stock is going to do ever. So if we need to spend this money on, let's say, our kids' tuition, we don't want to have that money in company stock within 5 years. Second question, what does the rest of your portfolio look like? I'm going to talk about this more in a moment, but just as a general rule, and I hate rules of thumb because we're all different. We all have a different situation, but just as a general starting point for a conversation, let's put it that way. If your company stock is more than 10% of your portfolio, you should probably consider trimming back. 10% is actually a lot. When you consider a typical portfolio, long-term portfolio should have about 10,000 companies in it. If one company represents 10%, that's a lot. Now, if neither of those above are true, still consider selling now. Diversification is the key to long-term success, and you've got your wealth, your money in company stock, and you've also got your paycheck coming from the same company. So you've got concentration, perhaps not just within your portfolio, but also considering the income that you have. So when should you sell? Sell, 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 sell. That's my base outlook for stock. Now we want to consider taxes and other things, of course, and I'll talk about taxes here in a moment, but let's talk about that second one. What does the rest of your portfolio look like? And I'm just going to take a sample. You should use your own numbers and go through this exercise yourself. I think it'll be very valuable. Here we go. How much company stock do you have as a percentage of everything? So let's look at percentage of total assets. So here we go. Here in this lovely blue, one of my favorite colors, 20% in company stock, 10% in savings. We always have some balance in savings, of course. 30% in our 401k, and 40% in our house. Remember, your house is an asset. Well, let me ask you this. Is 20% of total assets, are we comfortable holding that level of portfolio from a risk perspective? Well, maybe we are. But here's the deal. We've got this big chunk over here, this house that's 40%. We can't spend our house on things we need should the unthinkable happen, losing a job or losing a spouse who has an income or whatever it is. We can't really spend our house. So maybe the 20% isn't a fair measure. Let's take the house out. Now we're looking at financial assets. Well, same person, same numbers, same math. We just took the house out of the equation. Now company stock is 33%, savings 17%, 401k 50%. Now, are you comfortable at 33%? Well, before you answer, what about this 401k? Can we spend that? Probably not. If we're working age, we're not going to want to pay the 10% penalty to take it out early. Even if we're nearing retirement, we probably have other assets we want to spend first in retirement. So this isn't really available for spending either. So we got to take that out. Now we're going to look at liquid assets, assets that are accessible for us to actually spend and function in our lifestyle. Company stock, same person, same math, same numbers, 67%. Now we've got 2/3 of our available assets. We went from 20% to 2/3, 67%, tied up in company stock. You see how very quickly you can see that you might have a little bit more exposure or a lot more exposure than you once thought. So go through this exercise, think about how much company stock that you have and where you're comfortable in terms of risk. All right. Okay, let's talk about taxes. RSUs, as they vest, you are taxed even if you don't sell. So remember, we had the award date, nothing happens there because you don't really own them. Then a year goes by or whatever time period, you get to the vest date, you have $10,000 of stock vests. Now you've got $10,000 of stock, but the IRS says, well, that's $10,000 of income because you just received $10,000 of value in something, wasn't cash, it was stock, from your company. In fact, that's like a paycheck. So you just got a paycheck for $10,000 in the form of stock. So in other words, from a tax point of view, you just got a paycheck for $10,000 and you turn around and immediately bought stock with it. Now, let me ask you a question. When's the last time you took a whole paycheck and rushed right out and bought company stock with the whole amount? I bet that doesn't happen very often, very rarely. Although it happens every single time that you let RSUs vest and hold on to them. So you see, the momentum of that decision is such that it encourages you to hold the stock. But if you were given that money in cash, you would not go out and purchase the stock. So the concern there is you're building up this company stock unintentionally, as you don't need it, you don't want it, it's just happening. Now this happens to a lot of people when they start in tech and they can live off of their income, their salary, and they kind of ignore the stock and the stock builds up over time. Totally get that. Yeah, I got this stock, I don't really look at it. And then one day you turn around and you've got $1 million or $500,000 or $2 million. And now you've got to do something about it. Well, let's talk about somebody in that position who has stock that has vested in the past and has accumulated maybe over years. So what do we do there? Well, and how is it taxed? Well, it depends. First off, we need to understand from going through those pie charts that the right thing to do is to move it from where it is into our long-term portfolio. We're going to talk about building a long-term portfolio, by the way, in next month's webinar in May. And I'll give you the date and all for that. I believe it's May 5th. Anyways, so we need to be committed to doing that. It's going to cost us some tax, not sure how much yet. So we need to make a plan that considers how much cash we really need, if any, what our concentration level is in the stock, the diversification of the rest of our portfolio, that again, that's what we're going to talk about next week. And then the tax situation of each lot. Now, what the heck do I mean by that? Here's what I mean. If you have stock that vested yesterday, it's going to get taxed at short-term capital gains which is a higher rate, because you haven't held it for a year. If you have stock that vested 3 years ago, it's going to get taxed at long-term capital gains, which is a lower rate. But 3 years ago, the stock price was probably pretty low and it's gone up a lot. So a lower rate multiplied by a larger dollar amount might actually end up charging you more in tax in dollars, even though you're paying a lower rate. So how do we figure this out? Well, let me share a spreadsheet, and this spreadsheet is going to come via link tomorrow when we send the replay to this. So here's the spreadsheet. It's not perfect. It's a good starting point. The reason it's not perfect is all stock awards are structured slightly differently. So you have to really know how yours work. You have to know your tax rate and all, but here's how I would do it. If somebody came to me and said, hey, I've got this large amount of stock, what's a good plan to get out of it? So first off, look at the overall gain and the overall tax cost. If you're willing to take all of that in 1 year, don't even use the spreadsheet, just go sell it and you'll pay the tax in 1 year. And that's fine. But if you have enough tax that you want to spread it out over a couple of years and you're willing to take the risk by holding on to the stock, here's what we do. We got to look at the RSU detail, the stock detail. So here's an individual grant invested in 2017, 2018, 2019, 2020. Now we got to look at these by vest dates. 100 shares vested. The stock price was $80 when it vested. Stock price today is what I've plugged in here, 250. So the market value of 100 shares is 250,000. We've got a $17,000 unrealized gain. It's long-term because it vested in 2017. So we get the better tax rate. But we got to figure out the actual tax cost divide that by the market value. That gives us a percentage that we can now compare short and long term. So what this is percentage is saying is, here's a lot that is only going to cost us 10% of the value to sell out and access. Here's a lot that's 26%, and so on. Then you want to rank by the cost. And I know this is getting a little complex, but the point being, you want to get as much money out of the stock for the lowest tax cost. That's what we're looking for. So you might have a situation where you have $40,000 of stock, and so you might say, okay, I want to sell it over 10 years. So I'll sell 10,000 a year. That's the wrong thing to do. What you want to do is you want to understand the tax cost and say, oh, I've got $8,000 or let's say $20,000 of tax cost. Well, I want to get 20,000 divided by 4, $5,000 of tax cost each year. That'll get you out of the stock faster and have an even tax cost year to year. So that's the methodology I propose. I think it's really good, it minimizes your tax while getting the most out of, while diversifying you as quickly as possible. So that is the webinar. I see we have some questions already. If you have any questions or comments or anything you want to share, throw them in the chat or the Q&A, and I will respond here in a moment. But just to wrap up the webinar, here we go. So we talked about all that, but what about you? So I mentioned you're going to get an email with the slides and the RSUs. Download those. Look at these slides a little closer. 20 minutes is a very quick time to go through all of this. Look at the spreadsheet. Think about your situation and consider whether you're selling company stock at the right pace, whether or not you have a program to do that. And if you'd like, schedule a call with me. I'm happy to have a conversation with you. Again, I do these coaching sessions. They're normally $300, but since you attended this webinar, I'm willing to do one for free for you. I'm putting the link in the chat again, so you can go ahead and click it and schedule time now if you want. And we'll talk about RSUs, or we'll talk about any other topic that you want. So if you just want to make a connection and chat through something financial that's going on, happy to do that. Some resources that I have out there. I have a podcast, Deliberate Money Moves. Each episode is about a minute or two, and they're very, very sharp, targeted tips. I have a blog, and you can always email me, joe@bestfinlife.com. The way you know you got my email address right is I was too cheap to pay for bestfinanciallife.com. They wanted several $1,000s I was unwilling to give. So I just went with bestfinlife.com. Next month, May 5th, building a long-term portfolio. We'll talk about, okay, we're selling all this stock. What do we do with the cash that's left over? Well, it should go into your long-term portfolio. That's what we're going to talk about next time. Okay, just as a disclaimer, have to say this. This is not financial advice. Financial advice should be specific to you and your situation. I can only give financial advice to my clients where I know their situation, I understand what they're trying to accomplish. What we're doing today are simply talking about some, what I call money moves, some ideas to consider. I've got several webinars out there. You see them at the bottom of the page there. Happy to share those if you think they might be helpful. And there's the all important disclosure page. I'm going to go back to this page here, and we will open it up to questions. Again, just in the Q&A or the chat. And if you got to go, that's totally fine too. Thank you again so much for working on your finances with me today. I really appreciate it. I know this stuff is not a lot of fun, but I'm glad you showed up. So let's just go to the questions. Here we go. Is this tax rate, the tax rate I mentioned, I guess, for Canadians too? No, I have no idea. I don't know anything about Canadian tax. So sorry. You'll have to talk to a CPA or equivalent of a CPA, I guess, in Canada. Maybe it's CPA, I don't know. But you'll have to get advice specific there. I know US based law and specifically California law and some of the other states when we talk about state taxes. And I shouldn't say I know California law. I'm not a lawyer. I know California taxes to an extent, but I don't know what's different in Canada. Okay, here we go. Next question. If you sell your RSU as soon as it vests using the function provided by your company to immediately sell, some companies have those, some don't. You can actually set it up before vesting and say, what do they call it? Sell on vest or something. I don't know. It depends on the custodian. But okay, so we're talking about selling right when it vests. Are you paying short-term capital gains tax? Yes, you are. And that's the high one. But here's the deal. If the stock vests today at the close, let's say it vests at the close of the day at a stock price of $100. And so you're not able to sell it because it vests right at the close. But you set it up to sell tomorrow, you're going to sell at tomorrow's price. Now, how far is that stock going to move between today and tomorrow? Could move a lot, but it's probably going to move, what, $1 at most, 50 cents, 10 cents. So you're going to pay a higher tax rate, but on a very, very small dollar amount. That difference between the higher tax rate and the lower tax rate is about 15%. Call it 35% is the high one, 20% is the low one. So if you want the longer term tax rate, the lower tax rate that's 20%, remember that's 15% less, you're going to save 15% on taxes. You have to hold that stock for 365 days. And let me ask you this. What's the probability that your stock falls by 15% in those 365 days? And that's an important question, because if it does, then you would have been better off just selling at best. So don't get caught up too much in trying to optimize tax rates. Let's optimize tax dollars, okay? Thank you for the question. That was a good one. All right, here's another one. All right. I will have my first RSUs vest in July 2022. Good, congratulations, that's awesome. Grant date was June 2021. I usually hold stock long-term, but the tax on capital gains worries me, and I could use the money now to better my savings. Thoughts on holding or selling? Great question, and here's some great information for you. July 2022, they vest. You can sell it on that day, kind of like I was just talking about. And yeah, you might pay a higher rate, but the tax dollars should be incredibly low, right? Because the stock's not going to move very much between the time it vests and the time you sell it. So that's the tax question. More important than that is where you said, I could use the money now to better my savings, meaning I take that to mean that maybe you don't feel like you have enough in savings. Well, more importantly, let's get the emergency fund, let's get the savings where it needs to be. And it's okay to pay a little bit of tax to get that, right? We're talking about getting the stability of your financial situation. You want to get stable before you optimize. When we get into tax rates and tax strategy and all that, we're optimizing, right? We're trying to be perfect, but we got to be stable first. A good emergency fund, plus the amount of money that you plan on spending in the next 5 years over and above your income. In other words, if you're putting a new roof on your house or whatever the big expense is, big family vacation, you don't want to be the one to have to say, we can't go on a big family vacation because the market's down because I had the vacation money in the markets. No, 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 no. Pull that out, leave it aside. So that's your savings target. It's your emergency funds plus that extra spending in the next 5 years. It sounds like that's where you're at. So put it right there. Go ahead and sell it. And I'm not telling you to sell it. This is not advice, but from what you've told me, you need money in savings. You're not going to pay much tax if you sell right after vest, unless the stock moves huge. Just shore up your safety net, your savings target, and go from there. All right. Do we pay capital gains taxes only when filing our taxes every year and upload any docs that show the capital gains, or do we get charged for these taxes on day of sale? You do not get charged for taxes on day of sale. You only pay them when you file your taxes, because you get a 1099 at the end of the year. And what they do is they offset any gains and losses throughout the year, and then you pay tax on the net of that. So the IRS does not require you to pay tax on capital gains as they occur. The IRS does require you to pay tax on salary paychecks as they occur. So as RSUs vest, you'll notice that they'll automatically sell some and send it off to the IRS and maybe your state. That's remember, it's just like a paycheck. That's the paying as you go. It's never enough, but at least they do part of it. So hopefully that answered your question. Let's see. Hi, you're welcome. Is there any tax at all if you sell with no gain, short-term or long-term? Okay, so we're talking about RSUs. When RSUs vest, there's tax. You haven't sold it all. Then later on you sell, if you sell at exactly the same price that you were taxed at originally at vest date, sell at exactly the same price, no tax, no gain, no loss. You take the zero gain, if you will, multiply it by whatever tax rate, the tax is zero. That's how that works. So, so that it's the dollar amount that vests, that's what you get taxed on for income purposes. From there forward, you get taxed when you sell on any gain or loss. So if you have no gain or loss, no tax.